You send the Fed
Right.
back to doing its job of just being a regulator. You take away the power from, say, the office of the comptroller of the currency, make him then the comptroller of the currency instead of a super big bank regulator, and
hmm
have that same entity become answerable and reportable to the people through an electoral mechanism.
On the other end of the wormhole when we emerge,
Sure.
um, that would be fine, I suppose. And maybe that currency is backed partially by some hard assets too. Um, if we can get through the coming insurrection, if you will, and have that type of apparatus and structure in place, well, okay. To begin with, though, to think that the politicians are going to cede that power back to, not going to happen.
Okay. All right. Well, so much for trying to get an intellectual answer out of a guy by the name of Turd.
Yeah, yeah. Okay.
Okay. Well, we're going to move on to our next question. It will be posed by Skyhenge.
All right, this is, pardon me if I've butchered your name here, from Perflidit on silver availability.
Okay.
Taking as a premise that we have never left the greatest recession and seem certain to enter a fiat-induced implosion into the greatest depression, discuss the future of available silver, noting that most of presently mined silver is a byproduct of mining for minerals that won't be in much demand during a severe depression.
Well, that's an interesting idea. I would wonder if um, the mining of specifically for silver will become a profitable enough venture that will pick up the slack. You know, that everything that comes, the nickel and the this and the that, the zinc or whatever it is that comes out with the silver will be like a byproduct that nobody wants because they're going to all this trouble just to get the silver because it's worth $200 an ounce. That's an interesting yin and yang, if you will, of whether silver could be depleted just because it's not being mined as heavily. But like the first thing that comes to mind is that the mining activity, silver specific, may increase because the price has gone up so far due to the shortages. I mean, that would be kind of a capitalistic way to look at it.
Yeah, I agree that I think that you're right about that because obviously when silver gets valued a lot higher, they're going to be mining it specifically. And again, referring to the available silver topic, please discuss the topic of, say, for instance, jewelry suppliers encountering difficulty in securing silver for their customers. Is it plausible that Bix Weir of Road to Ruta is right and we're on the cusp of virtually unattainable significant quantities of silver bullion?
Yeah, maybe. The anecdotal evidence is out there everywhere. I mean, I get emails all the time from people pointing out, this mint is out of this, or this supplier no longer has this, and they're on back order for 3 weeks, and you get all this anecdotal evidence, and you think, I mean, after a while, maybe you really got something. Maybe get enough of all that line, all those dots connect into something that is actually there. And I don't mean to say that I don't, because I think it is there. You can see it in the sales at the U.S. Mint after the latest price takedown in September. The amount of silver eagles being sold through the mint were at record levels, and they already had sold more. I think they were ready to pass in October the amount of total sales that they had in all of last year, and there are a number of reasons for that, but that idea that there's a shortage is very real, and people are utilizing the dips in price to buy rather than to sell, and that is a paradigm shift that does not it's not going to reflect favorably on the balance sheet of J.P. Morgan and the like, in that it's going to be increasingly more difficult for them to drive price. And so they maybe in the end, they're going to welcome getting out of the game with position limits and say, we don't want to jack with that anymore. And I'm going to go off on a tangent here, but that is what happened in gold back in August. That commitment of traders report that I was mentioning earlier, you you can go back and look at it. You can clearly see the move from Sunday night, the 7th of August, until September the 16th or whatever it was almost entirely on the backs of bank short covering. And you think, well, you say, well, why that time period, and why did it break out and run from 1650 to 1920? Well, it was on the late afternoon of the Friday the 5th that the word finally hit the headlines that S&P was lowering the credit rating of the U.S. From a AAA down to AA plus. Gold opened about $20 or $25 higher that Sunday night on the Globex and didn't look back for 6 weeks. It finally went back down and filled the gap on the chart here a couple of weeks ago, which amazingly everything always seems to want to do. But the banks, the big holders, the big shorts, clearly took that as a sign that they had to cover some of those short positions. I mean, that you never want to be short anything. Margins are always high if you're short, and it's always very nerve-wracking because when you're long, you can only go to zero. But theoretically, when you're short, your position could move to infinity. And so it's a much more challenging position to be short. And clearly, the decisions were made post that downgrade to cover short positions. Again, the evidence is there in the Commitment of Traders report. We've since now, earlier this week, there was a report out of by Bank of America, which is still in business, I guess, as we speak tonight, but we'll see. Anyway, a report out of Bank of America that they're expecting perhaps another downgrade or other ratings agencies will go to AA plus by the end of this year because this whole super committee nonsense will fail to politically get any traction and the ratings agencies will be forced to cut. Well, if that's the general line of thought behind the banks, where they think the credit ratings are going, well, then you could rightly expect that maybe the banks start covering shorts again. Oh, and lo and behold, gosh, about the same time that report came out, gold then went up $100 this week. Oh, and lo and behold, we saw the open interest actually going down while that was happening. And open interest is the total amount of contracts outstanding. And if the amount of contracts outstanding is going down while price is going up, that is a sure sign that positions are being closed. Well, that's why open interest is going down, because positions are being closed. Well, what side of the trade is being closed if it's going up? Well, you're buying and closing short positions. Does that make sense? If anybody wants me to go back over that, I'll be happy to, because I kind of just breezed right through that. But anyway, I think people are expecting or beginning to sense that banks or that the U.S. will get downgraded again, perhaps as soon as December, and then you're going to get another run of short covering, which may have begun this week. God, and again, I'm sorry, I talked for 5 minutes. I have no idea what the original question was, and I'm not even drinking. I just must be getting old. So anyway, I hope that answered your question. Whatever it was, I hope that answered your question.
Well, basically, we're just discussing the attainability of silver and of physical silver, and how what do you think that as far as the demand and the concept of in the real world finding actual silver and in fiat terms or any other valuation that you think is more appropriate to value?
I remember the question now, and yes, I mean the evidence is there that there are shortages, and now I remember how I got off on that tangent, because we were talking about this buying that now develops when the price dips, and that I don't see that trend changing, and that will continue to press on physical demand. So the shortages you see now and the anecdotal evidence we have of it now will only continue, and that, I mean, so anyway, I believe it. I think that there are shortages.
So and what I've heard is there's actually some discrepancy on what you have to spend to get it, in comparison with the spot prices. There's actually started to be a digression.
Yeah, and that gets back to the physical exchange in China. That the premiums now are getting so high is what is really, the premium that you pay for that physical. It's like going on to APMEX or Provident Metals or something, and silver's trading at $35 an ounce, but they want $39 per eagle or per maple. Or if you go on eBay and try to buy it, they try to tell you, the futures market's trying to tell you it's at $35, but this guy on eBay wants $45. So what really is the price? And so that's that futures tail wagging the spot dog. In fact, Ned's metaphor is he takes it one further. He's got the bullion banks, the JP Morgan and HSBC and the like. They're the hand that holds the tail, that shakes the tail, which then causes the spot dog to shake. Works pretty well for them. But that demand, that's one of the key components to breaking that chain, no doubt about it. And it certainly looks like it's there, and it's going to continue to be there.
And you think it's going to continue to make a larger difference between what they call the spot price and the actual price?
Absolutely. No question about it. At least that's what I'm trying to do. I mean, that's what we're all of this whole group of us, I guess, whoever we are, in the blogosphere, trying to alert folks. The more people that, day by day that are awakened to this and realize that the only real financial insurance, the only currency that does not have a counterparty risk is gold and silver. And that demand is only going to continue to increase. I mean, what would change it at this point? Why would all of a sudden, oh no, everything's fine? I don't see that happening.
Well, based on history and common sense, I mean, I have to agree with you.
Yeah.
Thanks.
Sure.
Okay. For our next question, we're going to turn to Dr. Steve.
Dr. Steve.
Hey, Turd. Good evening. How are you?
Fine, thank you, Dr. Steve. How are you today?
Excellent. Listening and talking to you, it's wonderful. It's an honor.
Oh, gosh. Thank you.
You're blushing.
Yes. Yes.
Anyway, this question is from a WebBot member preferred it. It's on brokerages and mining. And the question is, it's regarding counterparty risks compared to the intrinsic advantages of owning physical precious metal bullion. It's my understanding that most brokerages register their clients' investments under their own street name instead of under the client's name. Is this true? And if so, what happens if a tsunami of brokerages simultaneously become insolvent? What is the actual role, for example, of the SIPC, and what is their capacity to effectively deal with mass brokerage insolvency?
I don't think they. I don't think they have a capacity to deal with it. It's like I just compare it to the FDIC, which is essentially the same thing. Banks paying the FDIC, Federal Deposit Insurance Corporation, to give this semblance of safety and guarantees to your bank deposits. The securities. What is it? Securities Investment Protection Corp or Securities Investor Protection Corp. It's the same thing for broker dealers, and they pay a premium to fund it. FDIC is all well and good when there's only 3 banks every Friday that go broke. They get bought by somebody else with some FDIC help, and then they reopen on Monday, and everybody's well and good. One brokerage firm goes out of business at a time. They can make the SIPC work. If they all collapse at once, well, getting your hand on your stock certificate is probably the last of your worries at that point.